Welcome back to Accountant's Desk. In this video, we will learn how to record journal entries using simple and practical examples, perfect for beginners. If you haven't watched our video on golden rules of accounting, make sure you check it out. The link is in the description below. And if you are a small business owner looking for accurate and reliable bookkeeping support, just fill the Google form in the description. We will reach out to you. Journal entries in accounting. What is a journal in accounting? A journal is a book of original entry where transactions are recorded in the chronological order as and when they take place. This means a journal entry is the first record of a transaction in accounting. It captures the date, amount, accounts involved, and whether they are debited or credited. Think of a journal as a diary for your business. Every time money comes in or goes out, you write it down with full details. Let's see the journal entry format. Date, particulars, ledger, folio, debit and credit. You record the date of the transaction and the accounts debited and the account credited, and then the narration. Let's now use the simple example and understand. Example: journalize the following transactions in the books of Mr. Ram. April 1st, business commenced with a capital of rupees 10 lakh. April 3rd, deposited in the bank account rupees 5 lakh. April 5th, purchased plant and machinery costing rupees 2,30,000 by paying 30,000 cash. April 7th, purchased goods worth rupees 40,000 for cash. April 9th, paid a check of rupees 2 lakh to the supplier for plant and machinery. You can see that on April 5th, we purchased plant and machinery costing rupees 2,30,000 and we paid only 30,000 in cash. And the remaining 2 lakh is paid on April 9th. April 11, sold goods for 70,000 rupees. April 15, withdrawn by the proprietor rupees 35,000 cash for personal use. It is a drawing. April 20th, insurance paid by check 2,500. April 22, salary paid 5,500. April 30, furniture of rupees 30,000 purchased in cash. We'll start with the first transaction. That is, business commenced with a capital of rupees 10 lakh. That means the owner is investing into the business. So cash comes in and capital is credited. Here the two accounts are cash account and capital account. Cash is real account, cash comes in the business. So debit what comes in. And the other account is capital account. Capital account is personal account and the proprietor is giver. So credit the giver. So we record it as, this is the format. Journal entries in the books of Mr. Rao. Date, particulars, ledger, folio, debit and credit. And we record it as on 1st April, cash account debit 10 lakh rupees to capital account 10 lakh rupees. And the narration is Beam Capital introduced into the business. Next transaction is April 3rd, deposited in a bank account 5 lakh rupees. Now cash decreases and bank balance increases. So the two accounts are bank account and cash account. Bank account is personal account. Bank receives the cash, so debit the receiver. And cash account, cash is real account. Cash goes out, so credit what goes out. So we record it as April 3rd, bank account debit 5 lakh rupees to cash account 5 lakh rupees, being cash deposited into bank. And the next transaction is April 5th, purchase plant and machinery costing rupees 2,30,000 by paying 30,000 in cash. In this transaction, 30,000 is paid now and the rest 2 lakh will be paid later. So we debit the full value of the asset and credit cash for what is paid and credit a payable for the balance. So here 3 accounts are involved. That is, the accounts are plant and machinery account, cash account and machinery supplier account. So plant and machinery, it is real account. Asset comes in the business, so debit what comes in. And cash account, it is real account. Cash goes out. So credit what goes out. And supplier is a personal account. And supplier is creditor. So credit the giver. So the transaction is April 5th, plant and machinery, debit account, 2,30,000. It is the whole amount. And next we paid cash. To cash, only 30,000. And the rest will be paying on credit basis to machinery supplier account, that is 2 lakh. And the narration is being machinery purchased partly in cash and partly on credit. That is 2 lakh we have to pay to the supplier. And the next transaction is purchased goods worth rupees 40,000 for cash. Here the two accounts are purchase account and cash account. Purchase account is a nominal account, expenses incurred, so debit all expenses. And cash account, cash is real account, cash goes out. Credit what goes out. So we record it as April 7, purchase account debit 40,000 to cash account 40,000, being goods purchased for cash. And the next transaction is April 9, paid a check of rupees 2 lakh to the supplier for plant and machinery. This is the same transaction from 5th April. That is, now we are paying 2 lakh rupees. And here the two accounts are supplier's account and bank account. Supplier's account, supplier is a personal account and liability reduces. So debit the receiver. And bank account, bank is a personal account. Bank balance goes down. So credit the giver. So we record it as April 9, machinery supplier account debit 2 lakh rupees to bank account 2 lakh rupees, being payment made to supplier by check. And the next transaction is April 11, sold goods for rupees 70,000. Here the two accounts are cash account and sales account. Cash is a real account and cash comes in the business. So debit what comes in. And sales is a nominal account and it is income earned. So credit all incomes. So we record it as April 11, cash account debit 70,000 to sales account 70,000, being goods sold for cash. And the next transaction is April 15, withdrawn by the proprietor rupees 35,000 cash for personal use. Here the two accounts are drawings account and cash account. Drawings account, it is a personal account and owner is the receiver. So debit the receiver. And cash account, cash is real account, cash goes out of the business. So credit what goes out. So we record it as April 15, drawings account debit 35,000 to cash account 35,000, being cash withdrawn by proprietor. And the next transaction is April 20, insurance paid by check 2,500. Here the two accounts are insurance account and bank account. Bank account because it is paid by check. So insurance account, it is nominal account and it is expenses for the business. So debit all expenses. And we paid by check. So bank account. Bank is a personal account. Bank balance reduces. So credit the giver. So we record it as April 20th, insurance account debit 2,500 to bank account 2,500, being insurance premium paid by check. And the next transaction is April 22, paid salary 5,500. Here the two accounts are salary account and cash account. Salary account, it is nominal account and it is expenses to the business. So debit all expenses. And cash account, cash is a real account, cash goes out of the business. So credit what goes out. So we record it as April 22, salary account debit 5,500 to cash account 5,500, being paid salary. April 30th, furniture of rupees 30,000 purchased in cash. Here the two accounts are furniture account and cash account. Furniture account is real account and furniture is an asset and it comes in the business. So debit what comes in. And cash account, cash is a real account, cash goes out of the business. So credit what goes out. So we record it as April 30th, furniture account debit 30,000 to cash account 30,000, being furniture purchased for cash. As you saw, every entry follows a logic. What comes in is equals to debit, what goes out or is owned is credited. So that's it for today's video. Now you know how to record the transactions in journal. If you found this video helpful, give it a like, share and subscribe to Accountant's Desk for more clear and practical accounting content. Check out the description for the golden rules of accounting. And if you are a small business owner looking for reliable bookkeeping services, fill out the Google form and we will reach out to you. Thanks for watching and we will see you in the next video.